Talks between Alibaba and Yahoo hit a snag. They need to rebuild trust before going back to the table, say our commentators. And the siren call of high yields luring investors into Europe's junk bond market. Watch out for the rocks, they say. With me is Edward Hadas. Nice to see you again, Edward. Let's start with Alibaba. Two companies arguing over valuation. Wow. Yeah. Surprise.
Yeah, this is a long story, and it looked last week, as recently as last week, that like they were going to find an amicable divorce. But as one often finds in these stories, the idea of the value has changed. Yahoo thinks they should be paid more, curiously, and Alibaba thinks they should pay less. There's also a problem with taxes. Yahoo would very much like to structure this deal as a tax-free transaction, but in order to do that, there's a lot of tricky stuff you got to get through.
And I think that the point that Wei-Gu makes at the end, the best incentive for clinching some type of deal is to get out of this unhappy marriage, right?
Yeah, and there's sort of a point between principle and practice. In principle, everyone wants to get the best value for their shareholders, and Yahoo's under tremendous pressure from its shareholders to do something. But in practice, at this point, it would be better if they could just decide that it's better to get a not quite good deal, but to actually get to the end result. So we'll see if common sense will prevail over high principles.
Okay. I want to move to this high-yield U.S. tourists sailing into the European storm piece. We talked so much about this. What numbers do we have about U.S. investors taking advantage of the situation in Europe right now?
Well, it looks like they are now coming in number. It's like 60% of the bond sales are coming out of Europe right now, or issued in dollars, which is obviously for U.S. investors of junk bonds, as high yield bonds. And it's a pretty natural thing. The bond yields are very low, and so the search for yield is getting high. Our worry is that a lot of Americans don't really understand the risks of the European market, and particularly if there's another severe recession in Europe, that even though yields are relatively high, they could get burned.
My question, I guess, is why now? My question is on the timing, and why now? Yields are coming back a little bit.
Right.
The ECB has been pumping money in for a while. I don't quite get the timing.
Well, I think timing is always mysterious. Why do investors suddenly get a little bit more confident? And one might argue, why were investors so frightened before? But in any case, what you've seen is that at some point, perhaps towards the beginning of this year, there was a tipping point, and investors in the US started to believe that Europe was not going to hit a crisis. The Eurozone was not going to collapse in chaos. And having been on the negative side, withdrawing money from almost everything European for several months, they've started to change directions, and the high yield market has been one of the main beneficiaries.
And how big? We talk about the slowing growth. How big are these rocks?
Well, as yet, the most recent economic data is a little bit more positive, but it's still quite easy to think of a major recession in Europe, and the high yield market again would be one of the first hit, because you're talking about some of the weaker companies that would be in serious trouble if we had another 2 or 3% decline in GDP in 2012 or 2013 after a Eurozone crisis.
Yeah. All right, Edward, many thanks for that. Edward Hadas from Breakingviews. You can watch our US Breakingviews show every day, 12:30 Eastern, 17:30 GMT. I'm Axel Threlfall. This is Reuters.